Ladies and gentlemen, I have the honor of introducing Rick Smith from Crosscut Ventures. Rick, thanks for being with us.
Thanks for having me, Sean.
The Awesome Office audience is in for a treat today. Okay, so when I walked into the office, which we got to talk about this building, it's a super cool building, but I noticed there was a lot going on in your office where people were getting ready to do some type of filming. What's going on with Crosscut right now? What are you guys up to?
Yeah, you happen to catch us. A pretty busy day today. So we are planning our annual meeting, which is next month. We usually dovetail it the last few years with the Upfront Summit. So a lot of VCs come to town, a lot of LPs come to town, just a lot of people in town. So their summit is like Wednesday, Thursday. We'll do ours Monday, Tuesday. And so that's next month. It's going to be, it's awesome. It's awesome to get all our LPs in town, all the we have several companies present. It's a very typical LP meeting in that sense. But today we're doing a little filming that we've never really done before, but pulling together a lot of the entrepreneurs from around town. The vice dean of UCLA is downstairs right now being recorded. Just a variety of different people that are just talking about the LA ecosystem. At Crosscut, we've been fortunate enough to be Crosscut for 15 years, but we've been in the ecosystem even longer. So we've had a sort of bird's eye view of what's been happening here, and we thought we'd do a video. Not so much through our eyes, but through the eyes of other people around town who have been big contributors to what's happening here in Los Angeles.
Yeah.
How cool. That's being filmed
How cool
today.
is that? And you've been in the venture space here in Los Angeles for 15 years, you said?
Yes. Yeah.
A lot's happened.
Yeah. Just a little bit.
Yeah.
Just a little bit. We started at Crosscut August of 2008. So the financial crisis took full form in September of 2008. So we started, our primordial soup, that first fund was in the midst of the general meltdown across really markets and countries and the entire world. So we had kind of an interesting start to Crosscut, and we started Crosscut. The backstory: Brian Garrett and I had worked together at our prior firm for several years. We decided that LA needed a firm focused on seed, focused on LA. And
what were you guys doing prior?
We were at a firm called Palomar Ventures, no longer around. But we were doing venture investing, but really Series A. And back then it was more the infrastructure of the internet. So we were doing Ethernet switches and all kind of telecommunications deals and things, and doing all of that. And that's great. But we were getting on planes and flying to Palo Alto once a week. I was on a board in Denver and Texas, and all that was going on. It was it was fine. But we noticed a lot of things happening right here in Los Angeles, and Lower My Bills with Matt Coffin and MySpace. Those companies were being formed under our noses, and Brian and I had partners who just weren't focused on that and didn't want to be investing in that. They were like, no, we're the infrastructure of the internet, and we're like, that's great, but LA right now is offering up something different. And so Brian and I said, let's go off and try to do a new fund based here in LA. We brought Brett Brewer in, who was a co-founder of the parent company of MySpace. And the three of us, the three amigos, went off and tried to do a new fund in Los Angeles. Back then, we would have half of our 15-page slide deck or 16-page slide deck would be on why Los Angeles. We had spent a lot of time. Why would anyone put venture dollars in LA? Why is it a market that we care about? Isn't it all in Silicon Valley? And we had to convince people. No, we're telling you, it's coming. You got to believe me. You want to be in Los Angeles.
What was the thesis back then when you would try to pitch these people on investing? Which, by the way, you were raising money in 2008, 2009?
Well, we closed in 2000, right before the financial crisis.
Okay.
So we got lucky in that sense. That was a small fund, first-time fund.
How big was that first fund?
$5 million.
$5 million. Okay.
Yeah.
Raised it all prior to the crisis. And what was the thesis back then of why Los Angeles?
Well, it was, here are the entrepreneurs that we're seeing in Los Angeles. Here, and there were several of the early internet and ad tech advertising technology companies had manifested themselves as, hey, this is going to be pretty interesting. And we said, no one's focused on LA. No one's here in LA focused on this, or very, very few people are. And if you look at the amount of dollars in Boston relative to the opportunity. Here in LA, we had very few funds and what seemed like big opportunity and growing. And looking back on it, we're right? LA's become the second or third biggest market in the world. I think the most exciting market with New York. New York's having a moment as well, but Los Angeles has really, hit its stride the last few years. A lot of funds here now, a lot of money coming here. Excuse me. And we couldn't foresee all of that happening, but we could sense that the trend was our friend in LA. And we were talking to people saying, look, you want folks on the ground. Seed investing is done best locally, right? Where entrepreneurs, engineers, recruiters, whatever it is. Seed is easiest and best done when you're spending more time with your company. So that was the original thesis. We didn't get buy-in from any institutions until our third fund.
So the people investing early on in that first fund, second fund, were more like high net worth individuals, mom pa type people?
They were all high net worth individuals who were, to be honest, investing in us more than the thesis. And our biggest investor was a good friend of mine from law school who wrote over half of that first fund and committed to that. And he's a very smart investor over the years. And he was just making a bet that, sure, Rick, we hear what you're saying about the market and stuff, but we think you guys are excited about this. We're going to back this. And he really put us into business. And then, Fund 2 was 2012. And 2012, 08, 09 were horrendous, worse than anything I've ever seen. Even today. Today's pretty bad, but, and hopefully we can get a chance to talk about that. But certainly back then it was, end of 08, 09, you could not get any, I don't care who you were, I could not get a company funded. It was really tough times. And our company somehow survived. We had made a few investments as we closed, and we did not lose a company during that time. But it was still 2010, 2011. It was just still kind of growing, getting back on its feet, the market, venture market. And so we had a hard time raising the next fund. I didn't think we were going to be able to. And then our company started to manifest themselves that, hey, we got some pretty good companies in there. And it just takes a while for seed companies to grow, obviously. And so we were starting to get some good feedback from our companies, which then made investors a little more comfortable. And then our big break came in Fund 2 with Steve Case, the founder of AOL, who today has something in a thesis called Rise of the Rest, which is really investing in technology outside of Silicon Valley. We were the poster child for that before he had the alliteration of Rise of the Rest. It was, he liked what we were doing. He wanted to invest in spur technology on across the country. And I said, without him, we wouldn't have had Fund 2 the way we did. And it really did set us up for Funds 3, 4, and 5. So, big shout out to Steve Case, very entrepreneurial guy himself, obviously, but really wanted to spur other funds to spur other entrepreneurs in various cities across the country.
That first fund that you had of $5 million, how many companies did you invest in? Do you recall?
19.
19 companies. Yeah. And out of those 19 companies, because you had to have had some success in that first fund where those companies did really well.
Yep.
How many companies did you invest in the second round?
Fund 2?
Yeah, Fund 2.
18.
18.
Yep.
And by that time, you'd picked up some traction, like you said. Were there any exits with those companies in that time period, or they were just growing at a pace where people were like, okay, Rick and his team, Crosscut, the Crosscut team are making really good kind of bets or investments?
Yeah. We do like to call them investments, not bets.
Yes. Excuse me.
Although
I had nothing by that, but more so like, you guys are they're making investments. You're taking chances on entrepreneurs and companies and whatnot.
Right. Where people really, it's hard if you don't live in this business day in and day out like we do, or even tangentially involved in it. But when we have people come to our annual meeting and they see the entrepreneurs speak, I still remember someone saying, one of our investors in Fund 1, a friend of mine who's at a big leverage buyout firm here in town, he's like, I had no idea you were backing people like this. Like, very impressive, tend to skew younger, but very impressive people who are passionate about what they're doing. And even though maybe a lot of the presentations may have gone over people's head in some way or not understand the nuances, they did understand, wow, these are an impressive group of folks. And so that, helped us raise Fund 2. We didn't have an exit when we raised Fund 2. The tradition in venture is you kind of raise Fund 3 off of Fund 1 results. fund 4 off fund 2 because it just takes that long to get those results. And so we didn't have results to, put on a paper and calculator and say, wow, these guys are great. But we did have a lot of success happening in there and a lot of interesting companies in those first couple funds.
And looking back on those early funds, what investment stick out to you?
Yeah, I mean, the ones I like best are the ones that perform the best. But so the very first investment we made was in Jason Nazar at DocStock. We actually did that before we had a fund. We put our own money into it and folded that into the fund. Jason he was a Pepperdine law student, lawyer, who was, did, hypnotic tricks at parties and stuff. But he just came in our office and said, I have an idea for documents and how people are going to look for documents. And he just had that enthusiasm and drive. Didn't have a lot of experience. He was in his 20s. But we said we want to back this guy. We ended up backing another time after that. But it's, that very first one was what kind of set the tone, I think, for the fund is we're gonna back creative, driven, passionate people who are going after big problems. Either we think they're big now or they're going to be big. And because we're in LA, which didn't have a lot of experienced entrepreneurs in it back then, it's probably going to be a lot of people the first time they're doing it, and that's going to be fine. That's going to be fine. We backed Adam Goldenberg. First company was Shoe Dazzle. It's now become a whole bunch of Fabletics, and it's kind of evolved into a e-commerce juggernaut based down in El Segundo. Adam, high school, I think he dropped out of high school, didn't go to college. Was one of the smartest, most creative, driven e-commerce entrepreneurs you'll meet in the country, but he happened to be one of our early entrepreneurs too. So, Brian Lee, Shoe Dazzle, young, driven, a little bit more. I think he had one or two other companies before when we found him, but that was LA back then. It was scrappy. And I think people saw us as scrappy. Like we were this little fund. We didn't have an office. We're talking to you now from this beautiful office that we're lucky enough to be in now. Back then we had no office. So we're meeting people literally with the barista grinding next to us. Like, what do you do? I can't. What was that? It seemed like an important point. So I think people kind of, the entrepreneurs felt like, okay, we had earned the stripes. We'd gotten sand kicked in our face trying to raise money. We understand their plight and their journey is so difficult that I think it helped us in those early deals or early years.
What do you look for in founders when you're making kind of those decisions? You talked about it a little bit before, where you want driven, passionate individuals that are, ambitious. What's the makeup of some of these founders that you're investing in?
Yeah, it is. It is all over the board, I will say. It doesn't have to be. We tend not to invest in, Harvard MBAs. A common theme, maybe the common theme, is there's some chip on the shoulder of who's ever coming in. It's not like they've necessarily, come from the worst parts of LA or something, but they've had some adversity in their life, and it may be at home. It may be, had a tough childhood growing up, or it may be, things didn't work out at prior jobs or something. But they're driven to prove something. Yeah, and make a difference. They possess grit. They have grit, and you can't buy grit. Yeah, true. And you'd like to instill grit if you can somehow. You can't.
So, are you asking that question, Rick, when you're sitting down with them, kind of getting a background on who they are and kind of what? Or like their childhood was like, or high school, kind of digging to find like where is that adversity early on in life?
Yeah, I mean it's maybe not that direct, but it's but we have to be careful. But it is more, tell me why you're doing this, because if I can understand the why, then we can figure out the what and the how. But and you hear some great stories of people that are just had a rough relationship with their dad growing up, and kind of out to prove something. And for better or for worse, those have worked out to be some great entrepreneurs for us. Yeah. And it doesn't mean you have to go through that to be a good entrepreneur. It doesn't, but it kind of is a built-in grit supplier of what I'm going to go. Yeah. I'm going to go prove this, and that's worked for us. There are some other things I like in entrepreneurs that. Apart from the obvious passionate and driven and stuff, but I definitely like entrepreneurs who say, I don't know. This is an intrinsically really difficult thing to do, is to start a company and be successful. It's really difficult. No one has all the answers. And so if we get someone come in that says they have all the answers, and we ask a lot of questions, and we don't know what we're talking about. They know a lot more than we do about whatever subject they're talking about for the most part. We're just going to be asking some dumb questions or maybe some good questions. And someone who thinks they know it all or want to project like they know it all, that's going to be a hard person for us to work with. We want to work with people who understand we're all in this together. Yet we are judging you. This is a honeymoon phase, right, before we invest, or the courting phase, I should say, before we invest. And so, yeah, we are judging each other. But part of that judgment is, can we work together? Can you admit, I don't know that? We're going to need to solve that. Let's, lock arms and go into this together. We very much want to have that relationship when we start any investment, any company. It's not clearly, we're trying to get our percentage and part of the company, but we really want everyone to be incented to move forward together and have that camaraderie and respect and trust that you can call me and say, this is not working out. My favorite CEOs are the ones that are like, you know what, this is not working. We got to pivot, or we have pivoted and this is what we're doing, or whatever. That way we're all, because we're going to find out. We're going to, there are some entrepreneurs like, well, if I just wait another quarter, the big deal will come in or something. Like, just we're along with the ride with you. Let us row with you, right? Don't wait until the quarter's over and then say it didn't work out. Let's figure out the problem together.
Well, I think what I'm hearing you say is transparency. Just having open communication, but also a sense of humility, as in, hey, I don't know this, and I'm going to let you know that either I need some help here or it's not going the way I hoped, and just being honest with you.
Yeah, and I think that transparency and letting us know, because then we can solve the problem together. Right?
Yeah.
If you're a more technically oriented CEO and marketing is not your thing or sales is not your thing, let's talk about that. Let's look, and then we can put a team around you that augments your strengths. Let you do what you want to do, and then pull people together. We don't expect someone to be a right fielder, a second baseman, and a pitcher, right? I mean, they've got different skills. And are there some similarities? Yeah, there are. But let's get the best people we can for those positions. And not every CEO is going to be great at everything. Most of them aren't.
Yeah,
right?
You have to be able to delegate, and you gotta have, with a winning team, you gotta surround yourself with people that complement what you're not good at, right? Complementary opposites. I think about that just all the time with our team, along with like this founders that I meet. Someone might be a big visionary, a sales guy, CEO, but then his right hand man or woman is really into the numbers, a CFO, a COO type. So it's like they're complementary opposites to a certain degree.
What's Mason's greatest strength?
He's very organized. Yeah, and he has great follow through, I would say.
All right.
Thank you. Yeah, so it's like he's what I would say is Mason and I are a great team, is because I have the relationships, getting kind of people like yourself onto the podcast, along with running my business, doing the podcast, and he's kind of handling all the back end when it comes to setting this up, the editing, the producing, getting all the marketing out, that type of stuff.
Great.
So we work as a great team in that regard. One of the things I wanted to go through with you was walking the audience through the different stages of venture, right? You have a seed round, you have A round, B round, C round, D round. It just kind of gets so confusing. Like, can you walk us through like what the typical company looks like in each one of those rounds?
Sure. And there is no typical, but let's kind of
it changes quite a bit, right?
I was telling 10 years ago, maybe when we started Crosscut, I don't think the word seed was really used.
Yeah.
It was still Series A was the first institutional round. And then at some point, I haven't been a historian on it, but I can just tell you from personal experience, certainly when I started doing this 25 years ago, there was not seed, or at least wasn't used like it is today. So today, a typical company, the very first few dollars that go in are going to be an angel round. You call that the pre-seed round if you want, right? And that is, $50,000 to $500,000, $50,000 to $500,000 that the entrepreneur may raise from someone that knows them, and they will not generally be investing in the business; they're investing in the person. And I'm always amazed, but entrepreneurs have a way of getting that out of people, right? friends and family round. Or if it doesn't work out, friends, family, and fools round, right? It's and,
so good.
And I tell my friends, by the way, if you have a chance to invest in the friends and family round, don't.
Yeah.
Right? Unless you are just investing in a person, because it's tough, right? And so the loss rate is going to be pretty high on those, but that at least allows them to hire a coder, depending on what the company is, but hire some early people to try to get something, in the primordial soup of a company, trying to get something to come out of that, so that when they go to raise the seed round, which would be the next round, that there's something there. Maybe it's a customer or two that can vouch for the problem, if not the fact that they're actually using the software or whatever the solution may be. Or it's just, more eyeballs, depending on what it is. There's some initial traction that allows the venture capitalists investing in the seed round, which is really risky, to have at least some sense that, of all the risk that we're taking, and we take a lot of risk. That's our job. We are risk takers, we're risk adjusters, and we're risk sort of estimators at the end of the day. Of all those risks, why is this one different? And, the more traction you can get, the better. We don't invest at Crosscut. We don't invest in seed companies because we love risk. We don't. We just love returns. And if you want returns, you got to take risk. Those two are together. That's finance 101. And so for these companies that grow out raising the seed round, just a little bit of traction is nice in normal markets. So that's they get a little bit of traction, then they raise a seed round. That's, in our estimation, that's sort of where we come in typically, and that's a $2 to $4 million round. We'll do half of that, and we'll bring in another seed investor in town or out of town to do that, or maybe it's some individuals that are investing in that.
And you just to clarify right there, you bring in the other partner in that seed round. So you are taking care of half of that, and then it's a partner that you think would be also bring a lot to the table.
Yeah, we'll syndicate it, right?
Yeah.
We call that, but we'll work with the entrepreneur. They may have someone else. They may have, they're obviously trying to raise money from a lot of VCs at one time. It may take you 80 meetings before you get the first investors say yes, and once you do, you may have someone else say, you know what, they said if you can get the round kind of come together, we'd be interested. So we'll ask them first, who do you want in this? Who do you want as a partner with us on this deal? And if they have someone they like, maybe a couple people they like, well, great, let's get them on board, because we want the entrepreneur to feel the most comfortable, have the people around the table, and maybe they like them from personality, and maybe they like them from, hey, they can open doors that we can't. That's great for us. And the reason we syndicate these deals, we want more people around the table rooting for this company, trying to make this company grow. And the way to do that is, bring in those other investors. And it's worked for us. We are working with those entrepreneurs to do that. If they can't, or they don't know someone they like particularly well, great. Let's go. We'll bring it out to our syndicate, our network, and see who we can find there. So that's the seed round that comes together. Hopefully that will last 18 to 24 months. Just enough, hopefully, to get traction that we can get the A. So when we're looking, Sean, at these deals, and we're looking at, is there team risk? Is there market risk? Is there product risk? A big risk for us, especially today, seed investors today, is the A round. So the financing risk, the risk that you're going to get the next round done. An advantage we have, because we're in this business so much and we have companies all the time raising money, is that we kind of know what the Series A folks are looking for. We know what the Series A venture capitalists are looking for. And it moves. It's goalposts that move a little bit, but is it $1 million ARR and annual recurring revenue? Is it $2 million? Is it software? Is it is it space tech? You need MOUs from big agencies maybe saying we're going to use this product. Whatever that is, we kind of know what that is. And so we play the golf course backwards a little bit and say, here's where we want to be when we're raising money in like 12 or 15 months. It's going to take us a while. It's going to be longer to get there, whatever. And then we kind of say, okay, this is where we want to get. Is that enough money to get there? And we work with the entrepreneur and say, is this really enough money to get where you want to get? You can't do everything that you want to do, but you can do anything you want to do if it's sort of focused enough. Or is this going to be enough capital for you to achieve our goals and to be able to raise that next round if you succeed?
And do you have, Rick, control over who they allow into the A round when you guys get in with the seed?
So if you
Is that
read-
case by case
if,
basis?
If you read the documents, yes, we have control in the sense that we can veto any round, but we would never do that. Like we would, at the end of the day, our job is at the end of the day, our job is get to the A round. That's number one, because all of our companies need capital. All of our companies are burning capital. They're not. No company we would ever invest in is going to be cash flow positive on the seed. If they are, we're probably not investing in the right place, because we need companies because you need to hire people ahead of time. You need to hire sales people ahead of time. You need to develop product ahead of time. Like you just can't make money until you kind of build it. And if you're going after something big, and that's, for us, it's got to be big.
Yeah.
So because we fail so much, we need the ones that succeed to succeed in a big way. Because big, you got to build up ahead of time. So it's the only industry out there, that I'm aware of, that you can actually be, that you're lauded, not lauded, but you're allowed to lose money.
Yeah.
That's just kind of what you do. Now, how much money you lose and how fast you burn, that's a thing that, reasonable people can differ on. And there's no entrepreneur worth backing that doesn't believe that next quarter is going to be really big. And therefore, we need to staff up for that. We need to get customer service people in there and customer success people in there and whatever. So that's a little bit of the tension and back and forth that goes on in that seed, that kind of seed period, that seed to A playbook. But it is, pick a beachhead. You can't do everything. Pick a beachhead. Get your product out. Let's get some positive, feedback from someone. So when the Series A comes in, the Series A, in my opinion, they want to see the kindling going in the fire. They want to see a little bit of a spark there. They don't expect the fire to be raging, but they need to see a little fire. So when they take the Series A money, they're pouring fuel on that to really grow it. It doesn't necessarily mean there's product market fit, meaning, yes, we know for sure there's people buying our product, but that helps a lot. And in these days, the more you need more traction in this current environment in early 2024, where we're talking right now. You need that. You need that to get money today. So we spend a lot of time in the seed working with our entrepreneurs, saying, okay, what's it going to take to get to the A?
Yeah.
But back to your question, can we veto any financing? Yeah. We can.
Well, it sounds like you're getting involved with the seed round, right? You're helping them kind of, I love your analogy of it's the golf course backwards, right? Like, okay, A is the goal. So let's work backwards on how do we get there. And you're helping that company kind of along the journey, along the process for them to find the kind of the A round.
Yep.
To another analogy used, it's the fuel in the fire, right? Like they have a little bit of a spark, they have a fire, and then the A round's coming in. And what's the size of most A rounds? I usually see it's I could be wrong here, but around $10 million.
Yeah, I think that's fair. I think 8 to 15 is probably the sweet spot.
Most of the companies I rep, it's between, call it 8 to 15, just like you said, on average around 10.
Yeah, and that may be going down a little bit in this market. People are being a little more conservative with the money, but yeah.
And then is there, in your opinion, is the big difference kind of call it the angel investor to the seed round to the A round? Like that's when there's a lot of moving pieces, more so than call it the A, B, C, kind of like those periods of time?
Yeah, that's probably right. I mean, there's more pivots that happen early on. The one thing we tell our entrepreneurs, make mistakes fast, right? Because you have, the one thing we don't have is time. And so let's figure out, is this going to work? Is that going to work? And if we're going to change, let's change now. So it gives enough time for the Series A investor to see the traction we have in that place without us having to put more money into the company. So that's what we're trying to get. So yeah, those stages, I think there's probably more. More moving parts to it. It's not the A and B are that easy. They're not, but it's and then you really do have to get. Then it's about sales efficiency and how much are you burning relative to how much you're making, and there's a whole different layer of operational expertise and metrics that kick in at some point. We're not so worried about those at the C level. We're just like trying to let's figure out people like this. It's just dogs with the dog food. Yeah. That's what we're trying to figure out.
Yeah. Would you be comfortable talking about capital stack of what it looks like from an investment standpoint?
Sure.
So you have entrepreneur owns a percentage of the company. You come in as the VC. They're offering up a percentage of the company, right? As every round goes, your percentage, the percentages change of what the entrepreneur owns, what the VC owns. Like, can you walk us through what that looks like, how that changes over time?
Yeah, sure. So a typical around the seed. If you look at seed investors overall, typical seed round investors collectively will have about 25% of the company when the seed round is done. So the entrepreneur starts with 100%, right, when they start the company, but then, or entrepreneurs, so they're splitting it up. And then it goes down. They give some money out to the pre-seed round. And so maybe that's 10% of the company. It goes out for that. So, capital is most expensive early on.
So you're saying like pre-seed, call it the angel round?
Yes.
They're giving out around 10%.
5 to 10%.
5 to 10%.
Yep.
Seed round is usually 50% split because you said there's usually two, you guys are putting together a syndication. So it's 25.
Well, 25 total. 25 total.
25 total. Okay.
Between the two. That's why you think about that.
So in this scenario, so far we have, let's just make the numbers easy, around 35% allocated out to investors.
Yep. But then we'll also require a 15% option pool to be put in. So about 50% of the stack after the seed round is with the bad guys, the investors, and the good guys, the entrepreneurs, have about 50% as well. Right?
Is it usually always 50-50?
Between those two groups?
Yeah.
No, roughly speaking. So,
yeah.
In my experience, the seed round gets between 20 and 35% of the company. 20% of the company when things are kind of go and it's really competitive, and closer to 35% of the company for the same amount of money when things are a little tougher, in tougher times. So valuations come down, our 3 million or 4 million buys more of the company because valuation comes down. So we never want to be in a position to own more than that, though, because we know the entrepreneur, first of all, is making substandard salary. They can surely make more cash somewhere else. They don't have a lot of benefits. Like they're working 80 to 100-hour weeks in a project that is more likely than not going to fail. So they need, it's only fair, and they need to have the upside that if it succeeds, they're going to do really well, financially do really well. So we want to maintain that ownership. Even if we could take more of the company, we don't. And by the way, if we did take more in the Series A and B rounds, they would come in, look at the entrepreneur and say, you don't own enough. We're essentially going to take shares away from us. They don't take it, sort of out of our vault, but like, okay, we're going to price this low. We're going to bring the CEO back up or entrepreneurs back up via an option pool. Essentially, they'll dilute us down later on. So we don't want to do it because it's not the right thing to do. It's not the right incentives, but it will be corrected at some point.
Yeah.
Anyway. So
could you explain the diluting process, how that works? Because you just mentioned it right there.
Yeah. So, we go in, let's say we own, as an investor group, we own 30% of the company when it's done after the seed.
After the seed. Then you also mentioned, kind of going back, that after the seed 30%, but then you usually work in options. Some seed investors can get an additional 15% on future rounds.
Well, the option pool is for employees. So we set up the option pool of, call it 12 to 15%, and that comes out of the entrepreneur's stake.
Yes.
All right. So it doesn't dilute us down. And we have that option pool, and that is for future hires. So you're going to hire a VP of engineering, you're going to hire whatever. That comes out of the option pool, and we want to make sure that's accounted for when we put our money in. And we're basically trying to look out maybe a couple of years and see, what option, who we're going to hire, what options do we need to get those people in, and have that accounted for in the option pool. Mm-hmm. So,
and the reason an entrepreneur would do that, just kind of take a step back, is because maybe they don't have the capital for high income to offer to a CFO or a very valuable player, where they don't want to allocate however much. So they're like, I'll give you shares of the company so you have upside, because I can't pay you probably what you'd be getting in other places.
Yeah. So good point. Sorry, let me back up. 100% of the employees at startups have equity in the company. There's not any other company out there, almost no other company out there in the world, any other industry like that, or any other stage of companies, right? If you walk into the hardware store, the hardware employees people working there don't have stake in the company. If you walk into almost any company, you walk into Macy's, whatever, they don't have stake in the company. 100%. You walk in and there's a front desk person at a startup, which we don't have a lot of, but if there is, they have equity in the company. So 100% of people have equity in the company. Yes, because the cash is a lot lower than it would be in other places, but it's also the best way to get everyone pulling together. even if you're paying them a lot of cash, which we're not, even if you were, you're like, well, what's the best way to have everyone focused on the ultimate goal, which is to create equity value in the company, is to have everyone have a stake in the company.
Totally.
Basic economics.
Yeah.
Like everyone's going to work in their best interest. You guys stake in the company. You know, and if we sell for X amount, your family, you're going to have generational wealth, or you're going to have, you know, enough to buy a new car, a new house, whatever it is.
Everyone's incentivized.
Everyone's incentivized the same way, pulling in the same direction.
Yep. Got it.
Yeah.
Going back to diluting, how that all works.
Yeah. So, you know, after the seed round is done, you have the cap table that's set, and let's say it's us at 30 and the option pool at 15, and the entrepreneurs, you know, and then the earlier stage folks have a little, and the entrepreneurs have whatever. That's set. Then the Series A happens. We all get diluted down the same, right? Because we're selling shares in a company. So everyone, if we sell 10% of the company, we all have 10% less ownership in the company than we did before. Entrepreneurs, you know, early investors, employees, whatever. Like everyone's diluted down. Now, we have rights in our agreements that allow us for all the rounds to invest enough money to maintain our pro rata. So if they're raising that Series A and they're selling 10% of the company, and we can put money into that to maintain our ownership.
That's what that pro rata means. That's basically pro rata. If you owned, call it 30% in your example, and they're in your seed round, and then they're going to A round, and you're going to get diluted, you have the ability to put additional money in, so you keep that 30% stake.
We have the right to put 30% of that round in. Now, the reality is the Series A investors, especially if it's a hot company, if they're raising a round, it's probably a well thought of company in some way. They often say, no, we want more ownership. Even though you have the right, Crosscut, to put more money in, we're going to ask you not to put more money in. And if you say no, then we'll walk away. All right. And so we always say, fine, you know, yes, we'll do the right thing, and we'll take less. So we will get diluted down more. We just have no power in that situation. We may plead with them and say, hey, look, we really do like this company. We want to put more money in. Is there a little way we can maybe raise a little bit more? Or you might be able to buy shares from the entrepreneurs directly. So you get more ownership, but we can put more shares into the round. There's some things we can do to try to keep our ownership up. But the reality is, as a seed investor, you're never going to end up at the end of the day with as what you start off with. Like, we will get diluted down over time. Our fund one, we didn't even really do follow-on investing, and we did really well in that fund.
Wait, you didn't do? I'm sorry, I missed that.
We didn't do any investing in follow-on rounds.
Got
the
it.
A, the B, the C. We just diluted down, and we still had a great fund.
And I could see a situation where you invested in the seed round, and every time the founder wants to raise, it dilutes you, and you don't want to put additional money in. Mm-hmm. So what happens if you run into a scenario, Rick, where there's a bit of a disagreement on another raise versus an acquisition or going public?
Yeah.
Does that happen?
Sure it does. Sure it does. I mean, more likely, it happened in fund, I think one or two. We had an entrepreneur who had an offer. We liked the company. We liked him a lot. Liked the company. They were getting traction. They got an exploding offer, meaning they got an offer to buy the company, but it was going to be, you had to say yes or no in like 48 hours or maybe 3 days or 4 days. And we said, look, I remember exactly where I was standing when I had this conversation. I was overlooking the ocean in Palisades Park in Santa Monica. I said, look, it's going to be your decision. We will back you, whatever you want to do. You know better than we do how much energy you have, how much gas you have in the tank, how much you want to take a risk here. It was, a nice outcome for him. It's not super big in venture terms, but it was a nice outcome. And I said, like, if you're going to do this, we're going to back you. But I think you're worth, it's worthwhile to say no and keep building. He took the money.
And in that case, you wanted him to keep building.
I wanted him to keep building if he wanted to keep building. We were going to be supportive of it. Now, to be fair, he would have had to raise a little bit more money. And we're at one of those inflection points. And, a point in a company's life where it's like, wow, if they make it through these next 2 or 3 months and close what we think we're going to close, we're going to be looked at as a different company. And we ended up doing that. And as it turns out, he will now tell you, damn it, I wish I hadn't sold. Because also this is a tough business, and unless you're Elon Musk, it's hard to have lightning strike twice or 3 or 4 times in his case, right? It's tough. And if this is as an entrepreneur, if this is your lightning striking, you want to maximize, what you get out of that. Now, obviously there's risk involved in that. And, when you sell, do you put the money in the bank and you're happy, and he was happy with that. He will tell you now, damn it, that's not enough money. After taxes and after, you elevate your standard of living, and it's like, now I'm buying, when he shows up in like some fancy Audi RS or something, I'm like, oh boy, it's like, it's gonna go faster than you think. And it did, and it does, and then he has kids and whatever. It's like, so, who knows how it would have worked out. But in that case, that's one where, we were trying to encourage him to say, go for it if you want. But he said no. We said, fine, we'll back you. We'll agree with you.
What's he doing now?
He's got another company, and we backed him. So,
are you more inclined to back entrepreneurs that have been successful in the past, or do you like, for example, I would assume if someone's been successful once, they're more likely to be successful a second time, and I guess that's less interesting to me versus you backing someone who's failed. An entrepreneur that started something, they failed, and they're like, hey, I want to start something else, and I learned a bunch of lessons throughout this road of starting this company. How do you look at those two things?
I do not give a flying rat's ass if you fail.
That's big to everyone listening, right? Like,
I don't care.
To your word, like right out of your mouth, it's you don't care.
By the way, I don't care if you succeeded.
Yeah.
What I do care about is, what did you learn when you were there, and why did you fail? And I would get back to our transparency conversation earlier. If you are blaming your board or your VP of sales or the market solely, then we're not gonna hit it off, right? But if you say, look, I made had headwinds, whatever, something changed or whatever, fine, but I could have done this, I could have done that, or if I did it again, I'm just looking for growth. And they say failures, you learn more from the failures than the successes. So which is true, but if you're successful too, it's like, if you walk in and say, I'm the greatest, like, that doesn't really work for me either. It's going to be, here's what we did right, here's where we got lucky, whatever. And so, no, but I'm also, it is easier to back someone it's easier to back someone we backed before, because we really do know, where the warts are there, and the strengths. But I'm not opposed to first-time entrepreneurs. In fact, there's a study a long time ago that even suggested first-time entrepreneurs had a better chance of success than repeat. I don't know if I can think of some anecdotal reasons why that may be. I don't know scientifically. That's not I can't cite a study whether that's right or wrong. But in my experience, I love more experience, but I love people who will admit what they've done right and what they've done wrong. Just
transparency, like you said, being honest and being humble. So, one of the parts of your industry that's always been kind of a little challenging for me, and I don't know if it's been challenging for the audience, but I would love to hear your thoughts on venture debt and how that works.
So the capital we've been talking about is equity, right? Yeah. We put money in, that's seed, that's A, that's B. But debt does play a role in venture. It really depends on the timing of the kind of markets and the company itself is sort of how I look at that. Look, I used to do leverage buyouts for a living. I'm not afraid of debt. I'm not afraid of putting a lot of debt on companies. Those were in situations where we were EBITDA positive and you could support it and stuff. I think venture debt has a role to play in our industry. I think one, though, has to be really careful when you bring venture debt into the cap table, because the venture debt provider is not in the business of losing money. We, unfortunately, as an equity investor, are in the business of losing money. We a lot of our companies fail. The loss rate, especially as seed investing, so we can absorb a loss and move on. Venture debt lenders are not that way, and so they're not in the business of losing money and making it up somewhere else in some other deal or whatever. So you have a constituency that is different and not aligned with who you are. It's not aligned with you as an entrepreneur, not aligned with you as an investor. they want to put their money in, get interest, and get their money back. And that can play a role, but the earlier that you take that debt on, the more risk you have at the company, the more you stand to run afoul of that lender. And it's not their fault. They're just trying to get their money back. But in those situations, they will have rights to really pull the company out from underneath you. And oftentimes, usually they won't do that because they know they can't run it. But it does just create a whole different level of conversations and considerations that you have to do when you bring debt on. Now, the advantages are it's cheaper, right? You're not giving up your company. So,
and if you're in an environment like right now where maybe not a lot, maybe there's not a lot of people that are investing, it's a different source of capital if you're in a crunch.
It is a different source of capital, but in particularly like times like this, it's tough because if you can't raise the next round, then that's when you start facing the issues of what do I do with this debt out there? And they're going to want to do things differently with the company than you want to do. They're not playing for the upside. They want to grab the assets and sell them and be done with it.
So what you're saying is it's actually harder now on the debt side.
I think it's harder now. Yeah, I think it's harder. I think the debt providers I've talked to recently say the good companies, really good companies, there's a fight for them. But the rest of them, it's like, they pulled back. So, which I think makes sense economically. Where debt can be an advantage is it is cheaper. So instead of raising more equity where you're giving up shares of your company, that if you're successful, that can cost you millions and millions of dollars, right? As far as equity goes. Here you got debt that comes in, interest paid back. That's great. Keep the company yourself.
They don't take any ownership.
Sometimes they will take warrants on that, but it's going to be pretty small, relatively. Certainly much, much smaller than if you raised equity financing.
And Rick, what are you seeing from that standpoint on the interest? Is it just dependent on the interest environment, or is it pretty standard like 8%, 10%, 15% on like what's the payback period? Like what do these deals look like?
It varies. Yeah. It varies. Sometimes it's interest only. Sometimes you're amortizing, you're paying back the principal too. The interest rate's going to be, they're all in return. By the way, it's been a great business. It's been a great business, for them over the years, but they're all in returns are mid to upper teens, IRR. So they're getting a combination of interest back on that, which is pretty high, especially these days relative to the last couple of years. And they're getting some warrants kickers too. So, they've done okay for themselves.
Yeah. That kind of leads me to another question that I've thought about quite a bit. So when you look at the stock market, on average, the stock market's done between 6 and 9%, depending on if you take into account inflation. Mm-hmm. I just was reading that private equity on average does around like 14%. Mm-hmm. What traditionally, and I know it's case by case because some VCs are, Crosscut's amazing, but there's other VCs that maybe aren't as good. Mm-hmm. Traditionally, what does VC normally do from an investment standpoint? And what is, if someone gives you $100,000 or $1 million, you're keeping that for 5 to 7 years. Is that the investment cycle? And then you're returning the capital? Like, how does that work?
Yeah. Well, there's a couple questions in there. So let me tackle the last one first. So at least in this, most venture funds, certainly are almost all venture funds, you commit to the fund. You're not investing in a fund, right? So we have people that just sign a piece of paper that say, we're going to give you $1 million. And essentially our funds go for 12 years. And we have no obligation to return any money before that. And so for us, but we only draw it down as we need it.
So for an example, I commit to give you $1 million right now. I sign a piece of paper, and I basically say, "Hey, Rick, I promise, but I'm going to keep that liquid, $1 million that you can call on it at any point during the 12 years."
Yes, yes, but if you look historically, we're going to pull down maybe 30 or 40% of that the first 3 or 4 years. We'll give you some idea, but we only pull it down as we need it. So we don't want that money sitting in a bank. We're like, okay, we have a deal we want to do. It's a $3 million investment, whatever. Then we do a capital call. And you have 10 business days to give us money. So it comes in over time. The LP's commitment is paid in over time.
Why does the VC do it that way versus just having people give you the capital now, you keep it over the next 12 years? And it seems like that would be easier to have into a bank account, a high interest bank account. You're making some money on it, managing it and deploying it. You don't have to rate capital call. And who knows if I still have that $1 million or not. I thought I had it, but I don't. Why do they do it that way?
Well, you're right about that part of it. But the reason is IRR. So we're shooting for, as an industry, 20, 25%, 30% IRR. And so if we had that money just sitting in a bank account even at the higher interest rates of today, it would pull that IRR down, returns down. So we don't want that money, right? We'll take the chance that we're going to have an occasional, and by the way, we haven't, knock on wood, at Crosscut had an LP that didn't make the commitment, but it's a breach of contract if you don't make if we do a capital call and you don't contribute your 2% of your $1 million in that capital call, that is a breach of contract, and we have all sorts of rights in those cases that go get it, including bring a lawsuit, which we've never done, but have needed to do.
So you want to call that money, just to make this super easy, you want to call that money right when you're going to use it, because that starts the clock of what the return is on that money, which juices up the IRR.
Even better, we call it after we need it, because we get a line of credit. We have a line of credit that we can pull money down on, which is a much cheaper interest rate. And so we borrow money from a bank, invest it, and then do a capital call. Now, that's shortened up the amount of time you can do that. And we're not trying to arbitrage like a lot of, by the way, the same thing is happening at private equity funds. The $50 or $15 billion private equity funds are doing the same thing that we're doing as far as the capital calls and the bank loans and all that kind of stuff.
So you, just kind of clarifying, so you make an investment, you pull down on your line of credit with your bank. That's how you make the initial investment. And then you call that money when it's basically when you need to pay back the bank or whenever you want the money.
Well, yeah, but the terms to pay that back are more like 2 or 3 months these days, as it used to be longer. So you got great banking relationships, is what you're saying. We have good banking relationships. But it's a great. They're taking a risk that our LPs don't contribute. And you look at our track record, look at track record in the industry. That's a pretty good bet.
Yeah,
that's a pretty good bet.
And you were saying the typical IRR. I mean, I guess you could talk about the fund itself, but in venture as a whole, what would you say it is?
Well, it depends on the time period. So I just saw some stats yesterday that the tricky thing about venture return. So I think if you look at the median venture return, it's higher than any other asset class. But if you look at the dispersion, the top quartile and bottom quartile, it's much higher than anything else too. So
really,
So
even higher than private equity.
Higher on the upper end. Right? Because you have some funds, especially the markets we went through, like there were some funds that were investing in Bitcoin at the right time that they had 1,000%, I remember seeing it somewhere, 3,700% IRR, right? We can't compete with that, right? We're not doing those kinds of investments. So the dispersion among venture funds is greater, which is probably what you would expect. No, it's not probably, it is what you expect, because we're investing in inherently riskier assets than our brethren and sisters doing, investing in private equity. They're investing in companies that have positive EBITDA. That they tend not to go out of business as much. So it's just a matter of how much they make at the end. So we take more risk. We have higher return, but it also means that the worst performing funds have much lower returns than private equity, debt funds, emerging market funds, whatever.
How many funds do you have, Rick?
5.
5 funds?
Yeah.
Smallest fund being that first fund?
Yep.
And then largest fund?
Yeah, 125 million. So we have slowly grown over time. The last 3 funds have been institutional backed funds from large endowments and foundations around the country.
And those funds, like you said, if someone gives you money, a check of $1 million, it's going to be 12 years.
Yeah, most of that. 40% of that's in the first 3 or 4 years, because that's the first 3 or 4 years are the times that we're making those initial checks. Typically, we're making the investments. Then the later years are more the follow-on rounds, which are a little less if we're following on. So if one of our companies raises this B or C, then we want to put more money in. Yeah, we'll draw money down for that.
And with people that want to invest, what would you say to the audience that's listening that's not an institution, maybe not a very high net worth individual, someone who has a little bit of investment dollars that they want to put to work? Do you recommend they team up with a venture firm like yourself, or put it in the market? You can't give investment advice, but what are your thoughts on people that want to get started in venture from an investment standpoint?
It's hard.
Yeah,
it's hard. I think I don't think it really is an asset class that lends itself to a smaller investor, just because it's inherently risky.
And you have to be accredited.
Yeah. Well, there's limits if you're not, but really, for the most part, you have to be accredited, which means you have to have a fair amount of current income or net assets.
I think it's $1 million of net assets
outside your house.
and then 250 making $250,000 a year for multiple years, something like that.
Yeah, but even if in that case, it's just a risky asset class. It'd be great if you and it's tied up for a long time. So the illiquidity for 12 years, and we typically tell people don't expect money back the first 5 or 6 years. I mean, so you're putting money out, you're not getting money back. Now, over time, you get enough money back that it creates a great return, but there's no guarantees in that, as you know, and so it's not for everyone. And even for those high net worth individuals and family offices that are doing it, I'm like, okay, take 1% of your entire assets, smaller percent, 5 or 10%, and say, okay, this is going to be my venture allocation or venture and private equity, leveraged buyouts and stuff. And then pick 5 or 10 funds to go in. I mean, I'm a very conservative venture investor, I guess, and so I don't recommend pushing it all off in the roulette table in black and hope it works out. It's not my style.
Yeah. The other thing we've noticed you've probably seen this firsthand over the last 15 years, is there's been this explosion in venture where there's all these venture companies that are popping up, people that want to start deploying capital into companies. What advice would you give to someone who wants to get into venture? Is it right for someone who's in their early part of their career, in their 20s, early 30s, to get into venture? Or is your recommendation, hey, go work for a company, learn operations, learn marketing, learn all the different components that go into running a company, and then go into venture at that point?
Yeah, venture capital had I don't know if it's still there today, although I get a lot of questions about how do I get in. But certainly the last 5 or 6 years, a lot of people are interested in how do I get into venture. The traditional advice that we give is go get experience somewhere else. You'll be a better venture capitalist if you do. Ideally at a startup, right? Go work at a startup. Go see what it's like to be on the inside, and it can make you a lot more knowledgeable and empathetic, I think, if you become a VC, if and when you become a VC. I did not do that, by the way, but I have had 25 years of working with companies, and I think I've developed my empathy over time and seeing how hard this industry is. So, yeah, it used to be you couldn't go into venture as a young person. Like there's zero option. Today, there's not a lot of options, and I think especially in the markets that we're in right now, you're going to see a lot of the funds shrink or go away, not expand. So there's not a lot of opportunity to get into venture. There never has been, but there's not a lot today to get into venture. So you really need a plan B anyway. Now the other side of that, I think being a venture capitalist is outside of pitching for the Dodgers is the best job in LA. We get in these offices here, we get these people that show up and say, this is how I want to change the world. It's how I want to leave a mark on the world. And we get to play, Shark Tank and say, no, yes, no, and then help people achieve their dreams. I mean, that's a really powerful place to be, and not power in a sense. It's a purposeful place to be. It just is great to be able to help people in that sense. Now, when they fail, it hurts. It hurts them a lot more than it hurts us, but it hurts us.
Yeah.
It hurts them because that's what they've spent 3 to 10 years working on and put all their eggs in one basket. We don't. We have eggs in now. We invest in 25 or 30 companies in a fund. And so, it hurts when we fail, and it is nice when we succeed. But when our entrepreneurs fail or succeed, it's a different modulation, right? Yeah. So, but yeah, I think if you can get into venture, it's been for me the ideal job and a great job, and a great. I don't feel like it really does not feel like work to me. I mean, I love diving in on stuff. We're making a push right now at Crosscut in climate tech, and I've been learning a heck of a lot the last couple of years. We've made a couple of climate tech investments over the years that have worked out really well for us. I think it's really important for the world, but more than that, I just think there's opportunity there. And for us, we're always opportunity first, and impact, if it comes, is great. But I will tell you, it's been nice to be thinking about investing and having impact. And so for me, it's just been diving in and learning about a bunch of different areas that I haven't spent a lot of time in. We've been generalists for the 15 years that we've had Crosscut. My colleague Brian is spending a lot of time on space tech, and We have a company called Umbra up in Santa Barbara, and that's doing great, and phenomenal growth in revenue year over year. I mean, the kind I've never seen before, because they take better images from space than anything else out there through clouds and at night. And it's just been it's to be able to invest in companies like that, but the range of companies like that, this is just a great job. It is a great job. It's just a tough one, and I always say it's easy to be a venture capitalist. It's hard to be a good one, right? Anyone put money into companies.
Yeah.
You can go to cocktail parties and say, hey, invest in XYZ, but boy, it's just hard, to return capital over a period of time. You're going up in a very competitive environment. A lot of startups that are funded that are competing with you. The incumbents are competing with you. It's just, you gotta be willing to lose. You gotta be willing to be a team player. It's just definitely a team player sport, both within our firm and with our companies. You can't go it alone.
Yeah. I love your baseball analogy because I think of VC very much like baseball. And I actually played college baseball, and it was, if I'm up 10 times and I get a hit 3 out of 10 times, I'm in the Hall of Fame.
Hall of Fame.
Yeah.
Yeah.
You're going to be failing more than you succeed in baseball. And I feel like venture to a certain degree is very much like that.
Every type of investing is like that. But yeah. If I have a book in me, which I don't think I do, but it'd be 1 in 10. Because if you look at movies, it's like 1 in 10 make it. If you look at books, it's 1 in 10. If you look at TV shows, it's 1 in 10. You look at venture, it's like 1 in 10. Dating is probably 1 in 10.
You got to write that book. That is such a great book, 1 in 10.
But there's some universal law of, I don't know, of just taking chances. And maybe if it's 1 in 1,000, maybe we wouldn't be doing it. But if it's 1 in 2, then everyone would be doing it. Maybe there's some universal truth there. But yeah, you look at different genre of whatever, and that tends to be. I was talking to some friends at CAA. They're like, yeah, it's like 1 in 10. Movies that we think those are the ones that make it. Actually, ones that get made are successful. If you think about our world, it's 1 in 10 or 1 in 20 venture investments that really do really well. But those are, we see 5,000 business plans a year. We do 8. So you look at the entire universe. It's the odds are against you.
That is a lot of companies.
5,000.
You're investing in 8.
Yeah.
Wow.
Yeah.
That's a lot of due diligence on your team's.
Well, we get good at the initial. There's a lot that just don't make the cut up front.
Yeah.
This is not what we do, or it's too small a market or whatever.
Yeah. I've actually never shared this on this podcast, but the reason I went into tenant representation originally was because I loved the venture capital space. And I wanted to be an entrepreneur myself, but I also loved real estate. My dad owns an office furniture company. I think I expressed that to you. Yeah. And I went into commercial real estate, and I found out that there was an opportunity to be in commercial real estate, but to work exclusively with companies. And I thought that was really cool, working with entrepreneurs. You grew up in an entrepreneur in the household. Yeah, but what was cool about tenant rep and why I loved venture capital was I learned early on, working with a lot of these startups, you create relationships with these founders, and when they're in the seed round or the angel round, if you have a great relationship with them and they trust you as an advisor, you have the opportunity to invest with them. And so early on in my career, I started taking my commission checks and actually putting them in to companies. And I realized very quickly, Rick, that it is unbelievably hard to be to make wise investments with a lot of these startups, because you could have the most visionary entrepreneur you've ever met in your entire life, but it just, like you said, it's 1 out of 20 or 1 out of 10. And so I lost quite a few early on.
You got tax write-offs.
that is tax write-offs, but I did hit one that was in the process of, should be going kind of public this year, which could be a huge, a great, call it a hit or double, maybe a triple, something like that. Yep. And so,
that's great.
Yeah.
That's the business. That is the business. You have to invest in a variety of companies to make it. And even then it's tough. And it was if I look back at that investment, it was the entrepreneurs. It was those two guys were just so much better than the other companies that I invested in. And it was their work ethic. It was their speed to get things done. It was whenever I'd worked with them, they were they could just move at such a speed that no other entrepreneur could that I was working with. And they had bigger vision. They were smarter. They weren't intellectually smarter, but they were super scrappy and had street smarts. And it makes complete sense to me that they are where they are.
But yeah, I haven't ever shared this
Yeah.
on this
No,
podcast that I actually
you
have
learned,
done a little
but
bit.
you learned.
But
Now
now
you
I'm
know.
not doing it anymore. I'd
Well.
much rather give my money to someone like yourself who's actually much more of a professional and just invest in real estate, which is something that I know, or the stock market. You know, I think it's important to diversify. But yeah, that's my little background in your space.
Right.
I'll let you know what happens in the next year or two if this company actually ends up going public. Hopefully they do.
I'll track the cars you're driving and see how it goes.
This has been awesome. This has been so cool. So, well, actually, this is a tradition we have. I always look to Mason right at this point and say, "Hey, Mason, is there any questions you have for Rick that we can ask?"
I have a couple questions.
Mason has a couple questions.
Okay.
Everyone. By the way,
the
Mason
back.
usually has one question. I haven't heard him say I have a couple questions.
All right. Here we go. Apparently, we didn't do a good enough job today.
And you guys did a great job. What, in terms of seed round, that's where you usually find yourselves. What level of success are you looking for in that realm? Is it more of the trend in our little ecosystem, or is it like a quantifiable number? What exactly is that?
Yeah, so that's a great question. How do you define the traction that we look for when we're looking for? Okay, when we're going to make an investment, we say we need traction. What does that look like?
Is that your question, Mason?
Totally.
Yeah. So I will tell you, it's a question I get all the time because they're like, well, if you tell me what you're looking for, I'll call you when I get there. I'm like, well, it's not really that simple. It is, it's a combination of factors. So we invested in a company called Picasso. That was the founder of Zillow that we're starting now. And so, okay, we didn't have any traction there, right? But we wanted to, so but he was putting his A team in there, Spencer Raskoff, and we say, okay, we're gonna back that no matter what. And so it is some kind of combination of team. It depends what the market is. If it's software, we kind of have a sense of where they need to be, and we want to see some traction. So maybe that's a few $100,000 of ARR, annual recurring revenue. It may be less than that depending on the market. But if you have that much ARR, we can kind of look at it and go, okay, the salespeople are being productive, whatever. In other situations, like it just takes longer because the product just takes longer to develop. When we were investing in the satellite company, they weren't going to have any revenue, but it was okay. Our products moved along to here, and this is what we can do with the antenna on the ground. We think it'll work in space, and so it does unfortunately vary by each deal. And if I could define traction better, it'd be better. I always refer to the Supreme Court case about pornography. There's like, we can't define it, but we know it when we see it. And that's kind of the way with traction. It's like, it is some combination of, certainly more is better, more revenue, but whatever it is, we're just trying to be able to extrapolate, because at the end of the day, we're just extrapolators. And the more data points we get, the more we can try to figure out, is that going up this way or is it going this way? And so, unfortunately, for us, there's not a hard and fast rule. Yeah.
Could you call it proof of concept? Is that a way to?
Well, proof of concept, I would probably go beyond that a little bit. I think it's easier if we're talking about software. Like if it's software, it's like, okay, you're going to provide the solution to a company. It doesn't take a whole lot to get that going. It does. I mean, as far as capital. So maybe you can get a first product out, minimally viable product out, and there's some customers and they're paying for it, right? If customers are willing to pay for it, and we can pick up a phone and say, what problem did you have? What other solutions did you consider? And why did you consider these folks? And are they charging the right price, high price, low price? Like that just makes our job so much easier. So beyond proof of concept, that is going down that road of product market fit. You have a product, here's the market, is there a fit? And the further we can kind of check those boxes, the better our life is, easier.
It's awesome.
Yeah.
Great question. You said you had two. Was there another one?
Do you find yourself investing more in? Is there a kind of rule of thumb in terms of risk when it comes to something that's providing a service versus a product? Like,
Yep.
do you typically go for one or the other?
Yeah, well, in on that rubric, we tend not to invest in service companies. So they can be good companies. You can make a lot of money. There's a lot of good service companies out there, but they tend to not be as fast growers because you're actually providing a service. They tend to be lower margin. They tend to have lower exit values, right? The multiple on revenue that they can get when they exit either IPO or sale is going to be less than software, right? Which is 90% margins and can be, scale relatively much faster than a service business. So we tend to move toward companies that have moved towards companies that can scale more quickly, which tend to be more software-oriented companies or tech-enabled service companies.
Yeah, that makes sense. One of the things we didn't touch on is your thoughts on where things are going, where we are right now, and where you think the puck's going.
Yeah, not in the net. So
That was really good.
I think it's being iced right now. I've been around a little bit. So I was there in 2000 when that collapse happened. I was there in 2008. This has been an odd one because tech has been in a recession for 2 years. Yet we have stock markets at or near all-time highs.
Yeah, explain that to me.
And the unemployment's near record lows, and so the last two tech corrections did not have such a divergence between the regular economy and the tech economy. I know they're somewhat intertwined, but even so, they're intertwined. Yet still, tech is so much different. So it in part is due to the tech run-up that happened during COVID that people just kind of it unexpectedly was such a great benefit for tech, and so, especially the big tech companies. They hired so many people, they had to eventually maybe contract. But holding that aside, we've had 15 years of near 0% interest, free money. And so a lot of money went into venture looking to chase returns. If you're setting at a big endowment or foundation, you can't get money out of fixed income, so you got to chase it somewhere else because you're investing for 30, 40, 50 years. And so a lot of money came into the industry. It's not an industry that inherently can absorb a lot of money because there's only so much you can do. So I think we had too much money coming in. We had valuations that went up. They are coming back down. They're still not down, I think, where they should be. So I still think we're probably 6-8 months away from that. And I think you're going to see, the industry continue to contract. I think you're going to see a lot of venture funds close up shop and move on and do something else. So all of that stuff's happening right now. Now, I will tell you, as far as, should I start a company now or not? In my experience, the drumbeat of entrepreneurship continues steadily, regardless of what happens to the Dow. Most of our entrepreneurs don't have a single share in the Dow. Like they're just putting all their money and effort and whatever into their company, and they want to change the world, and they don't care what's happening outside. Now, they have to care because can they raise capital? But for the most part, people still want to change the world. They still want to create the next great company, and there's certainly been a lot of great companies started in down times. Why is now a good time to start a company? It's you can hire people, you can retain people, real estate's cheaper, the people are cheaper. You have less competition for what you're doing because less startups are going to be started that are competing with you. The incumbents, may be more weak, whatever. It is a good time to be starting a company. I actually think it's a great time to be investing, but that's great for our new investments. For our prior investments, and I say we at Crosscut and we as an industry, we're just going to have a lot of triaging to do, right? I think we've kind of pulled, as an industry, we've held things together by duct tape and wire and stuff in the last year or two, and eventually that's going to come to an end. And if you're a good company, you're going to be able to raise capital. If you're a marginal company, you're not going to be able to. And we haven't really had it starting, but we're going to have a lot of those companies go out of business. It's going to be tough, but it's what the industry needed. And like I said, new investments, I think it's a great time to be investing.
Yeah. What about all those companies that got started and call it 18, 19, 20, 21, those VC companies that got started then that deployed capital during the kind of like the peak of the market? What's going to happen with those firms?
Yeah, I mean, there's going to be a big correction there. I think if you're a smaller firm, a venture capital firm, you raise money from a few individuals to get off the ground, you're not going to have had enough track record to show anything for that. And so to raise, and you're probably out of capital at this point, to raise another fund, you're going to have to ask them, to your initial backers, do you want to keep going even though I've shown you nothing, or I've shown you nothing but down rounds, right? And valuations going down. It tends to be in these kinds of environments, people just kind of shut their checkbook and go, I'm not going to invest anymore. I'm going to wait. I can wait. They're high net worth individuals. I can wait. So I think you're going to see less money coming into venture funds. That's just going to be tough for funds 1 and 2 to get to fund 3 or 4. But I think across the board, it's going to be hard to raise capital. I think institutional investors have pulled back right now. They can chase returns somewhere else as interest rates have gone up, and they're kind of waiting to, as a venture class, they're like, "Where's the money? Show me the money." And we haven't, as a class industry, showed them enough money back. We've shown them markups, but not money back, and they've been saying smartly, I can wait. Send me money when you get it, and then we'll talk about investing more. So I think all of that's happening right now. 2024 is going to be a pretty tough year. 2023 to me was a really tough year. I think 24 will be a little worse.
From a VC standpoint, a company standpoint, or
everything.
I
think it's just going to be hard to raise money in 2024. Venture funds are going to be struggling to raise money in 2024. Now, I think as you get to the end of this year, all you have to really get to, you don't have to get to the end. You just have to get to the point where it looks like it's going to get better. And the shakeout that happens is better for the industry. Less venture funds is better for the venture funds that survive. Yeah. Right? Just less competition. It's a basic math on that. So it will be a better place to be investing as the shakeout happens. And I think we're going to continue to shake out this year.
The law of attrition, basically, is what you're talking about. Is how much of the political environment and what's going on the international stage does that play into what we're seeing right now with this environment with companies / VCs?
Well,
I guess the uncertainty. I mean,
I guess if normally when you have some major international events going on, or uncertainty about the economy or the direction of interest rates or whatever, it is reflected in more volatile stock markets. We have some volatility, but I've been around long enough that I've seen a lot more. So when times like that happen, it should have no impact on venture, but it does, in my opinion, because it reminds people that equity has risk, and no equity has as much risk as venture capital. So if the public markets are having that much risk and has that liquidity, why the heck am I going to put money in venture capital, which has even more risk and no liquidity, or very less liquidity? So, but we're not seeing that in public markets, right? So it's just these are to me odd times. I'm a big believer in the asset class long term, and I'm not just saying that. It's a driver of jobs, of the economy, of innovation. The one thing that the U.S. still does better than anyone else is innovate. I mean, it's still the greatest companies are being developed, funded, and nourished here, on our soil. That's not something that we've outsourced to other countries. So I still think it's a competitive advantage for us. We have the smartest engineers in the world. We train the smartest engineers in the world. Sometimes they go back to where they came from, but we have the greatest schools. We have great engineers. We have thoughtful people. We have risk takers. It is how this country was formed, right? It was a bunch of risk takers that came from different parts of the world and settled here. So I think that spirit, especially in California, is still going to continue. But we are seeing great venture capital being done all over the country, which is great. Yeah, which is great for the U.S., great for those companies that have a hard time getting on the docket of people on the West or East Coast.
One of the things you mentioned earlier in the podcast was how Los Angeles was really exciting to you. What about Los Angeles makes you really excited right now?
I've seen the trend line for the last 20 years, 25 years. I just think there's still a sense of camaraderie in LA. The venture firms are still helping each other out. There's so many people that moved down here during COVID. It was happening before. We used to have an event just for people that moved here from San Francisco and New York. Now, but they were hiding. A lot of people were still hiding it. They come down and they work here during the week, and they're like, or they show their face. And now during COVID, people are like, you know what? I'm in LA. Coming down. It's great. There's so many venture capitalists here now. And we still have easy access to Silicon Valley. It's a 45-minute flight. So that's, I think, been a hidden secret. But LA offers such a better lifestyle to most people than San Francisco. San Francisco is a great town. I like San Francisco, but it's a whole different world down here. It's much more diverse. and it's just a wonderful place to to be. Now, does LA have problems? Yeah, they do have problems, but so does San Francisco, right? As far as the problems with the city, not venture capital problems, but problem with how we're dealing with the homeless issue and whatever. But that is the amount of enthusiasm I see in people that come to LA that are like, finally, I can do venture in LA. 20 years ago, you couldn't do venture. I was doing venture here 20 years ago, but it was hard. You had to fly somewhere else to do it. Now you can come here, you can do it. There's a bunch of experienced VCs here, a bunch of entrepreneurs here now. In the old days, if we had a company down here, we'd relocate a CEO to move down from Northern California, but we had to convince them, look, if it doesn't work out, we'll find you something else. But they're like, no, if I move down, it doesn't work out, I have to move back because there's not enough down in LA. Now there's enough down here.
Yeah, there's
like,
so much
just
opportunity.
Jump in, and we're open for business. Water's fine. Dive in, and if it doesn't work out, that company, we're going to find you 5 others that you're going to love working at, and it's just a great environment down here.
Yeah, you bring up something that's so interesting to me because you hear from the news and you hear from all the data that there's so many people. There's an exodus leaving California, going to Texas, Florida, Tennessee, right? But like you are right. Over the last few years, I've met so many entrepreneurs that have been coming from San Francisco or Chicago or New York that are coming here to start companies, and California gets all this news of the people like mass exodus that's happening here. We don't really talk about all the people that are coming to California, and like those types of people that are coming here are actually creating companies and doing things for the economy. So I think you're right. There's a lot going on right now.
Yeah, and I will tell you, and I've a lot of friends that have left. I'm now seeing people come back.
Yeah,
from those 3 places you mentioned, Texas, Florida, and Tennessee. And now people are coming back.
Are they still a resident in those states?
No. Well, they're talking about giving up the residency, giving up 0 taxes, and coming back to California.
Yeah,
because they miss the intellectual firepower in LA, in and around tech. Now, there's obviously great people and great companies in all 3 of those locations, but they miss California. They miss that part of it.
That's such a cool concept, intellectual firepower.
Yeah, in and around tech, right?
Yeah.
Because there's obviously Northern California and Southern California. California is still the leader in the world of tech investing, and if you want that and you want to be among the best of the best, then this is a great place to be.
Yeah,
and that's not that changing, and it's still topography and weather, it's unbeatable. Are there issues? Yeah, there are, yeah. and we got to tackle those issues in a no nonsense way, but we're as far as the tech is concerned, this is still a fantastic place to be investing.
Rick Smith, governor, 2000.
No way.
Something. Another?
No way. No.
You gonna try to make some changes here?
No, I think the changes are tough. They're going to require some. It's going to require some toughness, and I don't have that kind of toughness. Yeah. It's going to be tough decisions, and we can get there, but I can tell you it's going to take a different breed of folks. I think the electorate has got to get there, and I think it's more of a recognition that we have something really good here, and we got to make sure that we maintain it.
We keep it,
yeah, because it's not perfect.
Yeah,
for sure.
I totally agree. I think I said governor, but I think what I was referring to is mayor of Los Angeles. Okay, few last questions for you. Favorite books or books you'd recommend for the audience?
Well, I'm. You probably mean more business.
No, I don't. You could literally be anything that you want. Just books that you love or that you would recommend people read. It doesn't have to be business.
Well, I'm reading one now called A Sewing Girl's Tale, which is about the first rape trial in America. It's set in 1793.
Wow.
But it's a very interesting read on the history in New York, on patriarchy, on social status. It's it's hit me in ways I wasn't expecting. I just happen to be reading it now. It's really good. But one of my favorite books of all time is A Short History in Nearly Everything by Bill Bryson. He does just a really good job of explaining how small atoms are and how big the universe is. And I think when you read that book, it can't help but sort of open your mind up to, just how insignificant we all are, right? We are just this, this one planet that's circling around a relatively undistinguished sun in one of, a solar system in the galaxy that is one of billions. And so it's just, and he does a good way of explaining that in a way that is accessible. And I read that about the same time as Guns, Germs, and Steel, which is a great look at why certain societies succeeded, not the way you think, right? It's just happened to be lucky because we had minerals or iron or whatever, or we gave disease to native people and sort of wiped them out and we took over. It's a great explanation of I think a very holistic view of world and world order. I've also been reading a lot of books on the climate. The sixth extinction is a good one. That's we've had 5 extinctions. Looks like we're in the 6th one here. I think the planet will be fine. Humans won't. If we don't make some changes, and I think technology is going to be needed to make those changes. So I read a lot. I'm a pretty active reader these days. So I'm all over the board.
Are you someone who reads a book a week, a book a month?
It's probably about every 3 weeks.
3 weeks to read a book?
Yeah.
Are you listening to any Audible or?
Yeah, it's mostly Audible. I get almost 12,000 steps in a day because of my dog. And I just, because of that, I just am able to listen to books. And it's really open. I mean, I've read Anna Karenina and Don Quixote listened to them in the last couple of years. I wouldn't sit down and read those books, I think, but I've been listening to reading a lot.
Yeah, I love how Audible has this thing where you pay I think it's $10 a month and you get a book a month.
Yeah, that's what I do.
Yeah,
it's great.
Yeah, it is great.
Yeah.
It's really, really great. Any business books you recommend?
I mean, I'm slow to the game. I'm reading Atomic Habits right now.
I love Atomic Habits. I'm rereading that. I try to read it on almost every year.
Yeah,
such a good book.
It's worth a reread. It's not a business book, but the Wright brothers is a really good read if you love entrepreneurship and you love risk taking. And it's just a reminder that, I mean, if you see what they went through to put the planes in the air, it's amazing read. It's a really good read.
Yeah.
So I like that book. It got me reignited for entrepreneurship. Just reading that, I was like, wow, those guys really went through a lot, gave up a lot, sacrificed a lot. They believed they could do it, and there was a lot of reasons why everyone thought they were crazy, and they persevered.
Yeah. Best advice you've ever received?
Let's see.
Well, you also, sometimes when I ask that question, there's a bit of what's that bias where it's like, it's not necessarily the best advice, but it's the one that the bias that you recall.
Yes.
Like, I forget what that bias is called, but basically it's this idea of like a piece of advice that was good that you heard most recently, and that's the one you recall. The
recency effect.
The recall bias or something like that.
Yeah, I'm trying to think of something fundamentally more interesting.
What's, as you're thinking about that, what's the advice you find you give entrepreneurs most often?
Well, it's a lot of what we talked about before. You treat us like a partner, make mistakes fast. If you got to make a pivot, let's talk about that. But I also say you got to manage up the same way you manage down. I think a lot of entrepreneurs look at managing down. They know they got to manage their VPs and their people. I go, you also got to manage up. You got to manage your board. You got to manage your VCs. We have 50 or 60 active companies right now, maybe 70 active companies. If you hopefully we're doing a good job. But if we're not, tell us. Tell Rick, I need your help. Introduce me to these 3 companies, because we can get to anybody. We've been around long enough. So you got to manage up. You got to be proactive in going up, and just don't think that we're gonna be sitting there on a Tuesday night saying, "Oh, I just thought of this." We should be, but we got a lot of stuff going on, but we want to help, and So I think that can be really helpful. Use your board, use your investors. That's what they're there for.
Yeah, I love that. I've never heard that before, because you always think manage down, to your point, but thinking about managing up. So it's like taking care of the people that are actually above you.
Yeah.
It's a cool concept for sure. Best advice you've thought about it?
I'm trying to think why I think, has anyone ever given me advice? Of course they have.
What would you say, Mason?
Best advice someone's ever given me.
Yeah. Or what's some of the best advice you've gotten from this podcast?
From this podcast?
Yeah, I'll make it more specific. Might make it even harder.
Let's see. Best advice I've gotten on the podcast is know what you're good at, and more importantly, know what you're bad at.
Yeah.
That's a good way to put it.
Yeah, I would say I have a corollary to that. I think the best advice I've had recently, anyway, is don't worry alone.
Wow, that's really good.
Because you're going to have
really
worries.
good.
We're all going to have worries. We're all going to have stress.
Yeah.
You don't have to go alone. Don't go
so
alone.
Cool. Don't worry alone. Wow. It's like, I heard that quote recently. If you want to go fast, go alone. But if you want to go far, go with people.
I love that.
Yeah.
I love that.
Cool. Rick, thank you so much for being on this podcast. I had so much fun with you on. I learned a ton. Mason, I think you learned a ton as well. You're an amazing guy, and I hope to have you on again very soon.
Well, I loved it.
Yeah.
Loved it.
Thank you.
I appreciate it. Thank you.
Yeah.